If you were here for the last video, you have mapped price perfectly. You have higher time frame context, exposed higher time frame targets, and you know who is in control from an order flow perspective. But you're still leaving R multiples on the table because you're yet to understand internal range liquidity. So let's look at it and apply it to the trade. So what is internal range liquidity? So the definition is internal range liquidity refers to pockets of liquidity that exist within a price leg. So what we want to see is that price respects those pockets of internal range liquidity. They act as our entry points to then see price proceed towards higher time frame targets. So if we come back to what a price leg looks like, we have a swing point, a high, and a low. So in this case, it's a bullish price leg. Price created sell pressure, then pushed bullish, buy pressure came into the market. What did that create? A price leg, because we can see in the creation of these candles that buys are in control of the price action on our execution time frame. So now we can start to plot areas within the price leg. So internal range liquidity refers to pockets of liquidity within the price leg that we can trade from. And there typically are three types of internal range liquidity. So let's forget the swing points for now. We have first and foremost the order block, which is the last sell to buy. So we can see this entire range here from the high to the low of the order block is the zone where orders have accumulated before buy pressure comes into the market. Now you can either mark this as the high and low of the last sell or buy candle before the move, or you can also cover the low, the swing low. So this whole sell to buy. You then have the inefficiency itself. So between candle 1 and candle 3, we have a gap in price. This is the next point of internal range liquidity. This is where there is inefficiency in price that might want to be mitigated before we continue in the same direction. So this is called a fair value gap, a gap in price where fair value is yet to be traded. There is also something called a breaker block, and we're going to touch on that in a few videos' time. Breaker blocks are essentially failed order blocks, and they can work as amazing flip zones for our trades. So what to look for? Price legs that contain internal range liquidity. Internal range liquidity that aligns with our higher time frame candle closures. And lastly, internal range liquidity that is aligned with higher time frame targets. So it starts to become quite simple. We're trading higher time frame candle closures, higher time frame ideas. We're waiting for price legs to create in our favor, and then we're taking trades from points of internal range liquidity. So in this exact same trade, this exact same setup, where we have sell to buy, creation of the bullish order block right here. So we see price sold off on the weekly time frame. For those that are just joining, we're looking at the 12-hour time frame for our execution, and we're looking at higher time frame candle closures behind that price range. So we get sell off on the weekly, buy pressure, close above, price then comes back to mitigate this weekly order block. In doing so, we sweep below a previous weekly candle. So this is our weekly accumulation. We then expose a higher time frame target right here, which eventually gets run. So we have close inside. This becomes our manipulation candle. Then we're looking for our price leg and our internal range liquidity. So we have a bullish price leg. This becomes our swing low. And then the high of this candle becomes our swing high. We then have order block, sell to buy, and the creation of an imbalance. So we can mark this entire area as our order block. We then also have the creation between candle 1 and candle 3 of a bullish fair value gap. So we can mark that as our fair value gap. And essentially we have the exact same context as that on our slide. We have swing points, bullish action in the market, order block, fair value gap, and importantly, context, because we are looking at liquidation, close inside of this accumulation candle, and a high probability target. And if you've seen videos 1 and 2 of this playlist, you'll know that this is also a monthly continuation and a 2-week continuation target. So we have everything we now need. So instead of placing our long, when this candle prints, we can refine to either the order block or the fair value gap. Let's leave the stop loss below the low for now, but let's just make that little shift to say, rather than entering at the close of this candle, I want to enter at the internal range liquidity that exists in the price leg, which is the fair value gap. I cover the low with a slight gap, and I aim for my high probability target. This is a 2.5R swing trade that plays out perfectly. Pure distribution to the high. So that's now how we're starting to use internal range liquidity in combination with external range liquidity. Where's the external range liquidity? The liquidity points at the highs and lows of higher time frame candles. That's in video 2 of my first CRT series. So we're starting to piece stuff together now. This is how you take extremely refined, high probability swing trades. See you on the next video.